Well, our next guest says a $15 minimum wage could have major impacts on some of the fast food stocks. Let's bring in Eric Gonzalez, equity research analyst at KeyBank. Eric, great to speak with you. Specifically, I want to focus on some of these at-risk chains. And you say Longhorn, Texas Roadhouse, and Papa John's. How much are they paying right now? And I'm just trying to figure out, back of the envelope, if they went to 15, what would that mean in terms of an increase in cost for them and possibly a decrease in margins?
Hey, thanks, Melissa. It's great to be here. So I think in terms of the chains, if you look at on a geographic footprint basis, if you were to weight their footprint versus what the state minimum wages are, you'll notice that Jack in the Box, Longhorn and Texas Roadhouse and Papa John's, those have a specific geographic exposure that may lend itself to a greater delta between its blended wage and that $15. But that's not to say that these companies aren't paying above minimum wage in certain instances where there's a tightness in the labor market. So, I think the bigger issue here is, depending on which stakeholder's perspective you're coming from, whether it be full service or quick service, wage inflation is something that restaurant companies have had to deal with for a long time. And those with heavy exposure to states like California and New York, they've largely figured out how to navigate through it.
Right. I'm glad that you mentioned geographics, because that's going to be important in terms of figuring out what that delta is. In other words, what that difference is between what they're currently paying workers at the entry level and what the federal new minimum wage could be. So it looks like Texas, it looks like the South, Eric, might have the greatest delta. Which chains have the most geographic exposure? Is it Longhorn, Texas, and Papa? Because I think as investors, you're trying to figure out what kind of a hit is this going to be to these companies' earnings.
You are, but I'd actually pose a different way of thinking about it. And certainly those chains, Longhorn, Texas, they do have more exposure to the South and thereby a little bit less exposure to the North or to California. But the more interesting thing here is if you think about the franchise companies, those franchise businesses like McDonald's and Wendy's. Dine Equity would be another one. Those are highly franchised businesses that won't feel the direct impact of a rising wage pressure. Now that pressure will be felt by the franchisees, but to the extent that the franchisees pass on those costs, that will manifest itself into higher royalties for the franchisor.
Can the franchisees pass on those costs? Could you see a franchise owner of McDonald's charge more for a Big Mac than another franchise?
The larger chains have scale advantages, and you already mentioned technology on the program earlier, those self-order kiosks, different ways of scheduling labor. So there are efficiencies that the large chains can take advantage of. It's the smaller chains, it's the independents that are really going to struggle to pass on those costs. So, McDonald's, I don't see them raising prices by 10, 20% tomorrow, but they could pass on a portion of it, and the other, the rest of it, they can sort of manage their way through it. And then hopefully take share as some of those independents, if the independents try to pass on the full cost of it, then they're at a relative value advantage.
Eric, great to get your analysis on this. Thank you.
Absolutely. Thank you.
Eric Gonzalez of KeyBank. So, Jeff Mills, do you think about any of these restaurant stocks any differently?
I think about it kind of as a tale of two stories here. So one, you have some of the fast food restaurants where I just think generally they're going to be at a little bit of a disadvantage just given what they've done over the past 12 months and the likely headwinds they face as the economy starts to reopen. I think it was mentioned in one of the KeyBank research reports, but I do like Darden. That's a name that I've continued to pay attention to in the space. I think casual dining is going to have a little bit of a tailwind as the economy starts to return to normal, as we start to ramp up valuations. They've already done a really good job of controlling costs, so that makes them attractive to me. I like the diversified brands that they have. They're well-known brands. And if you just look at the chart, it's in a really nice, steady uptrend. It's looking like it's going to break out to new all-time highs, and the valuation is pretty attractive at 17 times 2022 earnings. So those are the kind of companies I would want to focus on in the restaurant space.
Yeah, it does seem that if you're a believer in the reopening trade, that a casual dining chain would have a little bit more leverage to that. James, where do you go within restaurants?
I like McDonald's, actually. It's a big corporation with a long history of dealing with economic cycles in our country. It's a brand that's never going to go anywhere. They're ahead of the curve. They understand what's happening in the economy, and they're going to continue to pivot. They have all the data, they have all the technology, and they have the breadth of understanding of consumer behavior. And so McDonald's would be my pick in this category.
Shepard Smith here. Thanks for watching CNBC on YouTube.